Hi, I'm Pattu from freefincal, and today let's talk about downside protection in active mutual funds. Do they offer this, or is it just a myth that they offer it? So, what is downside protection? Downside protection, very colloquially, means that whenever the index falls or the market falls, an active fund is expected to, or hopefully, falls a little bit less. Not every time, but more often than not, and that's what we shall define downside protection as, and we shall find out in a detailed study whether active mutual funds offer this. So there are many ways to measure volatility and downside protection. One is we could compare. One way to compare volatility is to compare the absolute volatility, that is, to compare the standard deviation of the fund and the standard deviation of the index. Standard deviation is, for example, if I want to look at the monthly returns over the last 3 years, I find out how much individual monthly returns fluctuate from the average monthly returns over that duration, and that's called the standard deviation. It's defined in a way it's always positive. Higher the standard deviation, higher will be the volatility. I can compare the volatility of the index with the volatility of the fund and check if the fund has a lower standard deviation. But that takes into account both positive and negative movements. Another way is to use the beta. The beta will tell you how much more or less volatile the fund is with respect to the overall market volatility, but it again takes into account positive and negative movements. The third is what is known as the ulcer index. I've talked about this before. I have tools which measure this. This is a measure of how much the NAV falls from its peak and how long it stays fallen. So it is a measure of volatility associated with falls or downside volatility alone, and it's also a measure of stress. It was earlier believed ulcers were caused by stress. Before they found out it was caused by a bacteria, but that's how the name ulcer index came through. We could also measure what is known as downside capture, and this is what I would like to use. That is, for let's say over a 3-month window, I look at the monthly returns and I find out all the monthly returns when the index gave a negative return. And for those months alone, I look at the fund's returns and I find out if the fund's returns were less negative or more negative. And so I calculate what is known as the downside capture using that. And if the downside capture is less than 100, that, for example, if the downside capture is 80%, that means that the fund has only captured 80% of the index's losses. So it's good. Less having a downside of less than 100%, a downside capture of less than 100% is always good. There are, of course, other methods. We will not worry about that. So what we are going to do now is to define what downside protection formally. So let's say I have 1,000 3-year window. So I have a rolling. Let's say I calculate rolling returns and I have 1,000 data points of 3-year returns. So over every one of those 3-year windows, I will calculate the downside capture, and I will find out for how many of those windows the downside capture was less than 100. So, for example, let's say if for 800 of those windows the downside capture was less than 100, 800 divided by the total number of data points, that is going to be called as a downside protection consistency. So if the downside protection consistency is 90%, this means 9 out of 10 times when you inspected the fund's downside capture, it was less than 100, which means that the 9 out of 10 times the fund was able to fall less than the index. The fund was able to protect the downside. The fund was able to offer downside risk protection to the investor. That's the whole definition. If you have any questions on this, please comment. I wish this was a class where I can stop and take questions, but I can't do that now. I'm almost tempted to do it. In order to find out if active mutual funds offer downside protection, we take 258 active mutual funds, and these are going to be regular plans for a longer history, and we are going to use these are the categories used and the benchmarks: aggressive hybrid Nifty 100, equity linked savings scheme Nifty 100, focused fund Nifty 100, large cap Nifty 100, value fund Nifty 100, large and mid cap Nifty large cap 250, multi cap Nifty large cap 250, mid cap Nifty mid cap 150, small cap Nifty mid cap 150. I have explained in the posts with links why I have chosen these indices. I don't want to get into it again. So we're going to find out rolling downside capture over 3, 5, 7, 10 and 13 years, because we have data from April 2006. We shall define a downside protection consistency of 70% as good. This means 7 out of 10 times the fund is able to offer downside protection or fall less than the index. That we will call as good. Of course, this is subjective, but then fairly reasonable. So over 13 years, we're going to take a minimum requirement of 200 downside capture data points. Number of funds is 94, and 78 funds had a downside protection consistency of more than or equal to 70%. So 83% of the funds sampled had good downside protection. For 10 years, we took a minimum requirement of 800 downside capture data points. Number of funds is 97. Out of that, 71 funds had a downside protection consistency of greater than 70%. So 73% of the funds in the sample offered good downside protection. 7 years, minimum requirement 1500 data points. Number of funds is 101. The funds with 67 funds offered good downside protection consistency. That is 66% of the sample set. Over 5 years, we took a requirement of minimum 1000 data points. 160 funds in the sample set, out of which 108 funds had good downside protection, or 68% of the sample set. 3-year windows, again 1000 downside capture data points is a minimum requirement. 173 funds, out of which 103 offered good downside capture, downside protection consistency. That's about 60%. So it's reasonable to say that active mutual funds do offer good downside protection. Anybody who just takes random samples and says, oh look, it should have offered downside protection, it's not happening, what is this and so on, that's just lazy research. You have to look at it more carefully. Now the point is that what about return outperformance? Now, I have shown, I don't want to keep going on, and it might confuse you with too many numbers, you may lose me. I have shown in the text, and you can check it out, about for 13 years, 10 years, 7 years and 5 years, about 40% of the funds in the total sample set have outperformed the index in terms of return for more than 70% of every possible period. That is, for example, if I have 100 13-year data points, and if the fund has bet the index 65 times out of those 100, then my return outperformance consistency is 65 by 100. We are going to again define 70% as a good return outperformance consistency, and typically about 40 to 45% of the funds have provided good return outperformance consistency. Out of these funds, if you look at out of the funds which have bet the index consistently, if you look at the data, 60 to 70% of the funds which have bet the index have very good downside capture. So so I can summarize these results as saying 60 to 70% of the of active fund samples have got good downside capture, and out of that, another 60 to 75% have bet the index. So 60% of 60%, it's roughly about 36 to 40%. Those are the funds that have bet the index. So again, if to summarize all this, I don't want to confuse you too much. Anywhere between 60 to 70% of funds have downside capture, good downside capture. They do tend to fall less than the index. It's not a myth to say active mutual funds have downside capture. However, all the funds have offering such good downside capture do not beat the index. Only 60 to 70% of the funds that offer good downside capture beat the index. I hope I have not confused you too much. If I have confused you, please excuse me. Go to the post and look at the numbers. My point is, please don't look at, okay, let me look at what happened from from February 28th to March 10th. Don't take random samples and say, see, mutual funds have not offered any downside capture, this is wrong, it's all a myth, and so don't do all that. That's just lazy research. You have to be consistent and you have to sample enough data points before you say any kind of conclusion. Of course, we live in the age of social media. Everybody's lazy. The authors are lazy. The people who read it are lazy. Nobody cares. Rigor matters. We have to be very rigorous in our research to actually say anything with data. Thank you. Bye bye.